Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring to you the most important stories that move the markets. I'm your host Anurag Bansal, and in today's episode, we'll talk about 7 stories. We'll start with insights from Axis Bank's quarter results. We'll then move on and talk about L&T's quarter results. In the third story, we'll talk about how India and China are slowly becoming friends again. Fourth, we'll talk about how China is accumulating stock of consumables. Fifth, we'll talk about MapMyIndia's new opportunity with the government. In the sixth story, we'll talk about how India is building an Aadhaar-like system for agriculture. And in the final story, we'll talk about Bank of Baroda's update on monsoons in the country. So let's begin with the first story. Yesterday, we had spoken about how Bajaj Finance saw an increase in the number of bad loans. This quarter seemed to be okay for them, but it became a little scary when you look at their non-performing assets or NPAs. Bajaj's bad loans increased from 0.31% in the previous year to 0.38% this year. Loan collections have also declined across the board. Overall, Bajaj Finance's rising number of bad loans is a concern for now, but we don't quite know what lies ahead because this is just one quarter. The rise in these bad loans could have been caused by elections, heat waves, or just seasonal effects. We will just have to wait and watch for now to see if this is just a one-off situation or it is the beginning of a bad credit cycle. But it looks like something is going on with all the lenders. Axis Bank, which is India's third largest private bank, recently released its quarterly earnings and things are not looking quite great for them either. The number of bad loans went up a little for them as well, and this is a worrying sign. Here is what the CFO of Axis Bank, Puneet Sharma, said on an earnings call. I quote,
"The gross slippage ratio for retail, CBG and Bharat banking segments declined year-on-year. The gross slippage of our wholesale business increased year-on-year on account of small value accounts. All accounts were less than 100 crores in individual size. This resulted in the bank's gross slippage ratio analyzed being 1.97%, increasing 10 basis points YOY. We continue to monitor our retail unsecured portfolio closely and have proactively taken risk actions on growth and underwriting filters as and when required."
The retail segment was the most significantly affected. It contributed to more than 80% of bad loans in this quarter. And the number of bad loans for this quarter stood at around 2%, which was a significant increase from 1.4% in the previous quarter. Now this is just for this quarter, but it is still a little concerning. Here is what the management said about the overall industry. They said, and I quote, "We have seen a spike, a slight increase in unsecured across the industry, primarily driven by high leverage, typically loan stacking that is happening. Now this means that borrowers are taking on too much debt by borrowing from multiple lenders, and this is a big problem because it shows that the consumers are in bad shape. Also, historically speaking, whenever people borrow too much, it does not really end too well." Moving on to the second story of the day, let's analyze L&T's quarterly results. See, L&T is one of the largest construction companies in India and they recently released their quarterly results. But as I keep saying, we won't really look at their profit or growth numbers in detail because the news outlets do a great job there. We'll rather focus on looking at trends that give us an insight into what is happening in the overall economy. Now, one thing that is surprising here is that L&T's international business has been doing really well. L&T has received new orders worth 4.9 lakh crores and this is about 2.2 times its total revenue from last year. Significant portion of these new orders come from international markets, particularly the Middle East. 2 years ago, international business contributed to only 28% of the business and it has now grown to 38%. The second interesting thing was Shankar Raman, or L&T CFO's, comments on the shortage of skilled labor. He said that India is losing skilled labor to infrastructure projects in the Middle East. On the earnings call, he said that if we are able to provide the conditions appropriate to India, the biggest lever differentiator is tax-free income there, which is in the Middle East countries. He expanded further on this by saying that, "I think the government in India requires tax revenue. It requires everybody to pay tax except the agriculture sector, which I don't understand." He continued his quote, "For whatever reason, we have decided to keep the largest employment sector not taxed, but the rest of the sector increasingly are being sought to be taxed." Now, the shortage of skilled workers in India is due to multiple factors. One factor is that workers are going to the Middle East and other places across the world because the pay is much better there. The second reason is something that L&T had highlighted last month and we had also spoken about in one of the previous episodes. See, India faced a severe heat wave problem this year, and this heat wave problem was so bad that construction workers could not even work for a large part of the day. The third interesting thing from their quarterly earnings report is that L&T is now trying to diversify its business. It is trying to get more projects related to sustainability and renewable energy. They are looking to get into nuclear energy, green hydrogen, and solar projects as well. Now, if you think about it, all of these tie into the broader theme of green transitions. Now, because of climate change, countries will be forced to spend on renewables like solar, wind, and clean energy sources like nuclear to reduce carbon emissions. And it looks like L&T is trying to position itself for all this transition. Moving on to the third story for the day, we look at how India and China are slowly trying to become friends again. See, in a previous episode about Reliance bringing back Shein into India, I had spoken about how India had banned Chinese apps. Do you remember the time when the Indian government banned several Chinese apps back in 2020? Look, after the 2020 ban, all Chinese companies needed to follow a rule. They cannot directly enter India or make any investments without the approval of the Indian government. Now it seems like India wants to go back to the pre-COVID relationship with China. The Economist recently published an interesting story about how the India-China relationship might be heading for some sort of normal. See, India and China have had a rocky relationship since their border clash in 2020, but it looks like things are improving now. India still wants China to fix the border issue, but it also needs Chinese technology and investments to boost its industries. In fact, despite all the push for Make in India, it is still a little hard for India to manufacture everything all by themselves. Whether we accept it or not, we will still have to rely on China for certain things. But what has changed? See, first, India has started allowing more Chinese professionals into the country by relaxing the visa norms. Second, sometime back PM Modi said in an interview that India's relationship with China is important and significant, and he voiced his hope for restoring border stability. Third, both countries are trying to manage border tensions better. Despite cutting down on Chinese imports, India still heavily relies on them, especially in the electronics and machinery segments. Now, if you're wondering how will this change happen, let me explain. See, leaders may refrain from making overly negative statements about each other. There is also a possibility that Indian and Chinese companies will figure out ways to work together because it is in the interest of both of them. From China, India needs technology, goods, etc. And from India, China needs a new market to export all that surplus capacity that they have built up over the last few years. By the way, at the same time, China's own economy seems to be slowing down. Now, the Indian government might also relax more rules to facilitate this cooperation. Many Indian businesses are urging the government to allow more Chinese investments and expertise to help their operations. Now, moving on to the next story, which is also an extension of this previous story, we'll talk about how China is slowly becoming a hoarder of certain goods. See, in one of our previous episodes, which was titled, "Is Geo Ready to be a Grown-Up?", I had spoken about the Chinese economy. A short recap for those of you who missed it: China's economy is facing significant challenges, which indicates a negative outlook. First, China missed its expected 5.1% growth in Q2 of 2024 and achieved only 4.7%. Second, it is relying heavily on government bonds, loans from banks, and giving financial aid to struggling companies. Third, consumer demand has remained stagnant, coupled with high youth unemployment and dramatic decline in home prices, which are the preferred investment for most people in the country. Now, this sounds kind of bad, right? Considering they aren't doing well, in an ideal case, they shouldn't be splurging so much. But that is not the case. China is accumulating large amounts of raw materials and commodities. Opposite to general expectations, China's imports of many basic resources have hit record highs in the last year, and the trend continues with a 6% increase in the first 5 months of the year. But why is China stockpiling, you might be wondering? See, it is definitely not due to increased consumptions, but a precautionary measure. They're worried about any future conflicts they may have with other countries, so they are trying to increase their reserves of critical raw materials, which is to be prepared in case something goes wrong. China has been building up its reserves of grain, petroleum, industrial metals, and defense-related minerals as well. Events like the US-China trade war, COVID-19 disruptions, and the war in Ukraine have made China stockpile even more. Now, here are some interesting numbers and tidbits about China's imports. Now, China heavily relies on imports. In fact, it imports 40% of its natural gas and 70% of its crude oil. But wait till you hear the last one. Governments are concerned about future shortages of critical minerals needed for energy and technology, and China decided to buy them just when they became cheap. So much so that 97% of its cobalt comes from imports now. Also, China accounts for approximately 60% of global soybean imports, and it has purchased more than half of all US soybean exports in the last 5 years. Less than 2/3 of the food consumed in China is produced domestically, and the rest is all imported. And now if you're wondering where China is getting the money to do all this, see, China is using up all its massive savings to pay up for all the stockpiling. Also, China's government prioritizes strategic reserves as part of its national security and economic planning, which ensures sufficient funds are allocated. Moving on to the next story of the day, let's discuss MapMyIndia and why its stock has been rising so much recently. See, in the Union Budget, the Finance Minister announced plans to digitize land records in urban areas. The plan is to do this using something called the GIS, or the Geographical Information System Mapping. In simple words, GIS helps create a digital and visual representation of our geography. Now, this is a big deal for MapMyIndia because it is one of India's biggest players in digital mapping. The recent budget proposed three main things that will really benefit them and other similar companies operating in this space. First is that rural land records will now get unique Aadhaar numbers and will become digital. Second, all urban land records will be digitized using GIS mapping. This means they will have a digital visual representation now. Third, the government will set up an IT system for property record administration, updates, as well as tax collection. And now if you're wondering why this digitization is such a big deal, let me explain why this would be beneficial. See, when the government wants to execute any infrastructure project or simply just collect taxes, it is practically impossible to manually visit every piece of land across the country to keep track. This eventually causes inefficiencies, slip-ups, and also delays. In fact, a recent economic survey mentioned that multiple highway construction projects were delayed because the government was struggling with digital land records. Now, this is also a big deal because just last year, the government spent over 2 lakh crore rupees and constructed over 6,600 kilometers of highway across the country. Now, if MapMyIndia can make this process more efficient, you can very well imagine the kind of impact they can have. Now, coming back to the initial point about the stock price going up, on the day of the budget, MapMyIndia's shares jumped as much as by 10%, and similar companies like Genesis International Corporation also saw their shares significantly rise. But talking about MapMyIndia specifically, they are currently in a great position to make the most of this massive opportunity that the government might provide to them. I'll explain how. First, they have an 80% market share in auto OEMs. This simply means that 80% of automobiles natively use MapMyIndia's maps, which is a great way for them to collect data. Second, they have shown impressive growth over the last few years, which means that the market is confident about them being able to handle such large government projects. But it's not all nice and rosy. MapMyIndia is now facing some competition from Ola, which recently announced its own map service. In addition, Google has also recently decided to reduce its map prices by 70% in India in order to attract more developers and companies. Now, while Ola's entry may or may not matter too much since they're relatively new in the market, but Google cutting prices certainly matters a lot. So all in all, it'll be very interesting to see if MapMyIndia can maintain its top position and cash on to the new opportunities by the government, or if competitors will come into the situation and overshadow the company. I'll cover the story further as and when there is more information available. Moving on to the sixth story of the day, we'll talk about how India is building an Aadhaar for agriculture. See, in the recent budget, the Finance Minister announced something called the Digital Public Infrastructure, or DPI, for agriculture. The government's aim here is to bring more than 6 crore farmers into the country's formal land registry system. Now, as you would imagine, this is a huge task. Therefore, the government plans on executing this with the help of something called the AgriStack. Now, simply put, AgriStack is a detailed digital database for farmers. Think of it like Aadhaar, but specifically for farmers. It'll be a massive digital repository with everything one would want to know about a farmer, including their identity, land records, crop details, income, insurance, loans, and even their revenue history. Now, the advantage for the government is that not all this data will have to be built from scratch. The government plans to use APIs to source this data from various other government sources, and they even plan to use satellite data from ISRO to get a detailed view of crops which are sown across the country during different seasons. Now, in case you're wondering if this complicated exercise is even worth it, I'll tell you why this is such a big deal. First, it eliminates all duplicate information related to agriculture. Currently, different government departments have their own databases, and this leads to duplication and sometimes even conflicting data. With this AgriStack, there will be less paperwork for farmers and more consistent information for policymakers to take better decisions. Second, AgriStack will provide easy access to information for both the government and the farmers through one single platform. Third, with real-time data on crop production, supply chain players like food processors and distributions can plan their operations more efficiently. This will help streamline many other systems and processes which are currently very haywire. Fourth, AgriStack will also be able to integrate market price information with crop data. This can help farmers make more informed decisions about where and when to sell their produce. Fifth, with comprehensive data available, policymakers can design more targeted and effective agricultural schemes. Basically, information gets passed on faster and therefore problems can be resolved sooner as well. Sixth, banks and insurance companies can use the data in AgriStack to assess the credit worthiness of farmers more accurately. Now, this can speed up loan approvals and insurance claims for these farmers. But it is important to note here that while more and better data is good, AgriStack can only be successful if the government and the private sector work to relieve all the underlying structural issues that plague the agricultural sector. Now, all of this sounds great, but all said and done, there are a couple of really tall challenges that the government will face here. First is that many land records are outdated or incomplete in India. Second is that the government will need a very complicated system to manage property disputes while digitizing so much of data. And third, not everything can be solved by technology. See, while things like AgriStack will help, the challenges that plague Indian agricultural are actually beyond technology. Things like outdated techniques, lack of access to formal credit, social cultural barriers, etc. are still important to solve. AgriStack can definitely solve some of these issues, but not all. And the effectiveness of AgriStack will only be seen when the government successfully implements it across the entire country. Moving on to the last story of the day, we'll talk about Bank of Baroda's recent update on monsoons and agriculture in India. Let me break it down for you in 5 quick pointers. First, to begin with, the monsoon has been strange this year. Some areas have seen surplus rain while others are really dry. For example, the southern and central regions got much more rain than usual, but the eastern and northwestern areas saw much lower rainfall than usual. Second, crop preferences have also shifted a little bit. The sowing of pulses, paddy, oilseeds, sugarcane, etc. has gone up significantly. But on the other hand, the sowing of coarse cereals, cotton, jute, etc. has really gone down. Third, our water reserves are now at only 29% as compared to 38% last year at this point. If the reservoir levels do not increase, there will be trouble for agriculture this year. By the way, this does not affect only farming but also electricity production and water supply in cities. This year, hydroelectric production had dropped sharply because of heat waves and India had to rely more on coal to generate power, which is not sustainable. Fourth, the rainfall in the first half of the year was below normal average this time, but it has now seemed to pick up a bit across the entire country. This means that food production will also hopefully improve and food inflation might eventually go down. Fifth, if you're wondering why all of this matters, let me explain. See, food and beverage inflation has consistently stayed over 7.5% since this year started, and it has now increased to above 8% in the last 1 month. And this was largely because of heat waves and the onset of irregular monsoons across the country. But now that monsoons seem to be getting better, this food and beverage inflation might really start coming down. And if that happens, the RBI will be more comfortable in cutting interest rates as well. Well, that's all the news I have for you today. I hope you found value in this. I'll see you in tomorrow's episode. Take care and goodbye.